Welcome to our in-depth guide on fundamental analysis, the cornerstone of long-term investing. In this video, we will break down the key components and showcase real-world examples to help you master this essential skill. Fundamental analysis is a method of evaluating a security in an attempt to measure its intrinsic value by examining related economic, financial, and other qualitative and quantitative factors. Let's dive in deeper. Starting with financial statements. The three main financial statements are the income statement, balance sheet, and cash flow statement. Together, these documents provide a comprehensive picture of a company's financial health. First, let's break down the income statement. The income statement, also known as a profit and loss statement, shows the company's revenues and expenses during a specific period. It provides insight into the company's ability to generate profit. An example, suppose Company X has a revenue of $140 million and expenses of $100 million in Q2. The difference of $40 million represents the net income. Next, we move on to the balance sheet, which provides a snapshot of a company's assets, liabilities, and shareholders' equity at a specific point in time. It follows the accounting equation. For example, if Company Y has total assets worth $500 million and liabilities worth $300 million, the shareholders' equity will be $200 million. Finally, the cash flow statement highlights the company's cash inflows and outflows over a period. It consists of three main parts: cash flows from operating activities, investing activities, and financing activities. A simplified example: if Company Z has operating cash flow of $50 million, investing cash flow of minus $20 million, and financing cash flow of $10 million, the net cash flow is $40 million. Now that you understand the financial statements, let's move on to key financial ratios. These ratios provide quick insights into various aspects such as profitability, liquidity, and solvency. The price-to-earnings (PE) ratio is one of the most commonly used metrics in fundamental analysis. It measures a company's current share price relative to its per-share earnings. For instance, if Company A's stock is trading at $50 and its earnings per share are $5, the PE ratio is 10. The current ratio measures a company's ability to pay short-term obligations with its current assets. A ratio above 1 indicates that the company can cover its short-term liabilities. For example, if Company B has current assets worth $120 million and current liabilities worth $80 million, the current ratio is 1.5. Next up, the return on equity (ROE) ratio measures a corporation's profitability by revealing how much profit a company generates with the money shareholders have invested. It's a key indicator of financial performance. Suppose Company C reports a net income of $12 million and shareholders' equity of $80 million. Its ROE would be 15%. Another critical ratio is the debt-to-equity (D/E) ratio, which indicates the relative proportion of shareholders' equity and debt used to finance a company's assets. For instance, if Company D has total liabilities of $150 million and shareholders' equity of $100 million, the D/E ratio is 1.5. Understanding these ratios can significantly enhance your ability to evaluate companies. However, no analysis is complete without considering qualitative factors. These include management quality, competitive advantage, and industry conditions. Management quality is crucial as it directly impacts a company's strategic direction and operational effectiveness. Assessing management involves looking at their track record, reputation, and strategic decisions. Competitive advantage, often referred to as an economic moat, defines a company's ability to maintain its market position and protect its profitability from competitors. Lastly, understanding industry conditions is essential as different sectors have varied growth potentials and risks. Consider economic cycles, regulatory environment, and technological changes affecting the industry. Let's wrap up with a real-world case study. Analyzing Company XYZ, we will go through its financial statements, key ratios, management quality, competitive advantage, and industry conditions to understand its investment potential. Company XYZ's income statement shows consistent revenue growth and controlled expenses, leading to increasing net income over the past 4 quarters. The balance sheet reveals a healthy current ratio of 1.8 and a low debt-to-equity ratio of 0.5, indicating strong liquidity and low leverage. Financial ratios show a P/E ratio of 15, indicating fair valuation relative to peers, and an ROE of 18%, reflecting efficient use of equity to generate profits. Qualitatively, Company XYZ has a seasoned management team, a strong brand, and a significant competitive advantage in its industry with innovative products. With sound financials, attractive ratios, robust management, and a competitive edge, Company XYZ appears to be a solid investment opportunity. Remember, fundamental analysis is a detailed process that requires comprehensive evaluation. Each component plays a pivotal role in making informed investment decisions. Happy investing!